Hey, what's up, everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in 2026 and you're trying to figure out exactly when these interest rates are going to drop. Stick around. In this video, I'm going to teach you why they're finally going to drop in 2026, when they're going to drop, and what you should be doing in the meantime to strategize and get yourself in the right position to buy a house. Let's get into it. So far in 2026, DFW is not seeing much of a fall off. This is the year that everybody thinks the market is really going to rally, especially with interest rates projected to get to the 5s. So I want to talk about in this video, interest rates, why they will finally drop, when they're going to drop, how much they're going to drop, and as a consumer out there, what is the right time? Should I keep waiting, Brian, until rates get to the bottom? Should I do it now because I can get a better deal on the house? Should I do it somewhere in between because they get the best of both worlds? These are all great questions, but I think 2026 is the year that rates will finally drop. A few reasons on that. Number one, the most important thing is the announcement about this administration potentially buying $200 billion in mortgage bonds. Effectively, what that means is they're just guaranteeing that money to investors. For, context on that. When they bought bonds back in COVID, they did about $60 billion. And obviously it drove rates down and it protected the hedge, the market. So everybody liked that. And it made investors feel good because obviously their investments were secure and bought. So they didn't have to worry about too much loss, if any. They're talking about $200 billion right now. I don't know if that'll actually happen, but when obviously the government goes and buys bonds and they secure bonds and they back them and they insure them, people flood into the bond market. And when you put money in the bond market, what happens is rates tend to drop. So that announcement happened a couple of weeks ago. I've already seen rates drop down about a quarter. Then what I think you're going to get is your natural trend of with the way things are going, with obviously inflation coming down, economic growth. In May, we've got obviously Jerome Powell is going to be replaced. I think whoever replaces him is going to be a little bit more interest rate cut friendly because obviously affordability is a big issue. So I think 26 will be the year that rates are going to drop. I don't know how much. I would say as of this video, 30-year fixed notes, probably somewhere around, well, let's just say 6.25 to be safe. I think by the end of the year, they could get the 5.25. And I think sometime maybe end of Q1 27, they could get as low as 4.5. Now, that stuff could happen faster. I don't necessarily hope it happens faster as fast as I want it to happen. I want rates to get low so everybody can refinance and buy a house. If you do it too quick, it causes too much of a boom. And obviously that's not what we want because we want to create an increase, but we don't want to create a boom because obviously it makes things spike too hard and obviously prices people out of the market. So my hope is the entire year of 2026, what we should see is hopefully about a 0.25% drop every quarter of the year. That would be my hope. So a quarter in Q1, a quarter in Q2, a quarter in Q3, a quarter in Q4. That would be a percent of an interest rate. That means if we're at 6.25 right now, at the end of the year, we'd be at 5.25. I think that's a safe space. I think when rates start to get 5s in front of them naturally, 5.99, 5.8, 5.75, people tend to start to go. That's not only the consumer that's waiting on the sideline for affordability, it's also the people that are current homeowners. They've got 3s on their mortgage and are thinking, man, I can't trade my 3 for a 7. They're okay trading their 3 for a 5. And I think that's fair. So what you're going to see is you're going to see activity from both sides. This year, you're going to see rates come down. So you're going to see people that are first-time or second-time buyers from an affordability standpoint start to move back into the marketplace and start to buy. You'll see sellers that have got 3% rates, maybe even 4, be okay with selling their current property, downsizing, or even upsizing, and trading that 3% rate for a 4.99 or a 5. And so it's going to bring people to the middle. And I think it's very, very healthy, especially for DFW. One statistic I did see about 2.5 weeks ago, U-Haul released some of their data reports, and Dallas has the most people coming into it. That is great for our economy. It's great for our state. It's great for jobs. The downside of that, folks, is obviously the more people that pour into Dallas, everybody that lives here must have a place to live, either rent or buy. I think if you're a buyer out there, you have to consider the following. A year ago, interest rates were probably in the high 6s to low 7s. Now they're probably the low 6s, maybe high 5s if you're perfect, but let's call it low 6s to be safe. Everyone was waiting on interest rates to drop. They're down 1%. The downside of waiting too long is when you wait too long, everybody else has the same idea. And if you get 2 or 3 times the people all moving back into the market off the sideline at one time, yes, they can get cheaper rates and cheaper payments. The problem is we still have an inventory shortage. I know Dallas feels like there's a lot of inventory out there, and there is, but compared to how many buyers there are sitting out there waiting, it would eat the inventory up quick. The other downside to, not having enough inventory when all the buyers come off the sideline is the closing cost piece. So some people just think about when buying a house, think about the monthly payment only, which is important, but obviously with, homes, you've got closing costs, maybe 10, 15 grand depending upon the size of the home. But right now, you're still able to get a property to get the seller to potentially give you some concessions, which means they can pay for the closing costs for you. So you got to think in your mind, hey, would I rather have a 6.25% interest rate right now and my monthly payment would be $200 higher? Or do I want to wait till that interest rate's 5.5%, my monthly payment's $200 lower? However, the $10,000 in closing costs that I could have got the seller to pay for, now I've got to pay for on my own. So the math on that is you take the $200 extra that you've got to pay, obviously for the mortgage, but you get to keep $10,000 in your pocket. Divide those two together, that's a 50-month break-even point. That's 4 years. So you have to look at both of them. And I say all that to say, this is the year that rates will come down. I think they'll move steadily. There may be some indicators out there that move them faster or slower than we think, but I think by the end of 26, they'll be 1% lower. But you as a buyer have to figure out, okay, they're better than they were. There's opportunity out there. You can kind of have a little bit of the best in both worlds, where you can get a lower rate, a cheaper payment, still negotiate a deal on a house, and potentially have some sellers out there help you pay for the closing cost. And remember, in this scenario, if you get a property today or in the next month and the rate's at 6.25% and you get the seller to pay for the closing cost, and a year from now or a year and a half from now, rates are at 4.99 and you want to refinance, you always can. There's no out-of-pocket expense on refinances. You roll the closing costs in the transaction. You skip a month's payments. Your break-even point's pretty quick. But also, for you as the buyer, if you buy now and rates drop to 4.99, houses appreciated about 4% average each year. You refinance in probably 18 months. Your house is probably going to be worth 8 to 10% more, which means you're making money on the appreciation. The value will be better at the refinance time. If you had PMI, it'll go away. So there's a lot of benefits in buying a little bit sooner rather than later in case you need any help with the cost, all of that. If you don't need help with the cost, you may wait. But I think still one of the offsets is as rates come down, it's a scale, right? So rates come down, prices start to go up. Now they haven't come down far enough and fast enough back in 25 for it to really disrupt the market. But I think 2026 obviously is going to be the year that it happens. So I'm excited about it. I'm also excited because we've got a lot of clients out there that closed on a property in 24 and 25 and their rates are in the 7.5% and 8%. And they've got some temporary buy downs and those buy downs are about to be up. And now is the time that we can reset their financial position, get them a rate in the high 5s, low 6s, save them a lot of money, but they don't have to be out there trying to fight the street, throwing contracts on houses and trying to win offers. So again, best of both worlds. If you're a buyer out there, 26 is the year the rates will come down. You just have to time it according to the market and your actual needs. And obviously for the others looking to refinance, things are starting to open up. We're having second looks with a lot of people, repositioning PMI, lowering the interest rate. A lot of people are taking ARMs, 7 and 10-year ARMs, because the rates are even better on those, and those are currently in the 5s. So I'm excited, you should be excited, and we're excited for DFW as a whole for 2026. So listen, if you found this video useful, do me a favor, like, comment, subscribe, or feel free to share. And if you have any questions, drop a comment below. Listen, if you're looking to buy a house in 2026 and you don't know where to start, or you're even looking to maybe refinance a property, I just want to have a conversation around your unique scenario, do me a favor, call us, text us, email us. We're always here for you. Until next time, stay tuned.